If you bought the Nasdaq on March 10, 2000, you had to wait 15 years just to break even. Not 15 years to get rich. 15 years to get your money back. The index hit 5,048 that day. It didn't see that number again until April of 2015. Everybody knows the dot-com bubble popped. But almost nobody knows the actual numbers, how far things fell, how long the wait was, and why two people who bought on the same day ended up in completely different lives. That last part is the one most investors get backwards. Here's the number that still stuns me. The Nasdaq didn't drop 10%. It didn't drop 30%. From peak to bottom, it lost 78% of its value. Think about what that means. $100,000 became $22,000. And it happened in slow motion, 2.5 years of watching your account bleed, month after month, hoping every bounce was the bottom. The bottom finally came on October 9, 2002. 1,114 points. Down from over 5,000. And the S&P 500, the boring, diversified index everyone calls safe? It got cut nearly in half. Down about 49%. But the index is just an average. The real horror stories live inside the individual stocks. And one of them was the most valuable company on earth. For one brief moment in March 2000, Cisco Systems was the most valuable company in the world. Its market value touched $550 billion. Investors weren't crazy. Cisco built the plumbing of the internet. The story was real. The problem was the price. At the top, people paid around $80 a share. Then the stock fell almost 90%. And here's the part that hurts Cisco: the business kept growing. Revenue climbed. Profits climbed. But the stock? It took more than 20 years to get back near that 2000 price. So think about the last hot stock you almost bought because the story sounded unstoppable. Did you ever ask what price the story was already baked into? Cisco proves a brutal truth. You can be completely right about a company and still lose most of your money. Because you paid for 20 years of growth on day one. And there was a CEO back then who said the quiet part out loud. This is the part most people never hear. In 2002, Scott McNealy, the CEO of Sun Microsystems, a darling of the bubble, looked back at his own stock. It had traded at 10 times revenue at the peak. And he said something no CEO ever says about their own company. I'm paraphrasing his real words. At 10 times revenue, to pay you back in 10 years, I'd have to give you 100% of revenue every single year, no costs, no taxes, no research, no salaries. He called the assumptions ridiculous. Read that again. The CEO thought the price was insane. The market didn't care. Sun eventually fell more than 95%. Here's what nobody tells you. The bubble wasn't hidden. The valuations were screaming the whole time. A price-to-earnings ratio isn't a boring statistic, it's a warning label. And in 2000, the label was flashing red for anyone willing to look. So which camp are you in? Do you buy the story, or do you buy the price? Tell me below, because this one splits every investor I've ever met. Now the twist. Because not everyone who bought at the top got wiped out. Picture two investors, both buying in December 1999, near the frenzy. Both of them bought Amazon. At the peak, Amazon hit about $107 a share. Then it fell to around $6. A 94% collapse. Investor A couldn't take it. Watching $100,000 fall toward $6, he sold near the bottom. Locked in the loss. Swore off stocks forever. Investor B did nothing. Just held. And that same Amazon went on to become one of the most valuable companies in history, up more than 200 times from that bottom. Same company. Same buy date. Same crash. One outcome was ruin. The other was a fortune. The difference wasn't the stock. It was whether they could survive long enough to be right. Remember what I said at the start, 15 years just to break even. That sounds like a tragedy. But the real lesson isn't avoid crashes. You can't. The lesson is this. The bubble punished two things above all else: overpaying and panic selling. Price protects you on the way in. Patience protects you on the way out. Get those two right, and even buying near a top isn't a death sentence. Get them wrong, and the best company in the world will still ruin you. So be honest, have you ever bought a stock purely because the story sounded unstoppable? Yes or no in the comments, I read every one. Tomorrow, we're breaking down the one balance sheet number that would have warned you before 1999 even started.